Does everybody need life insurance, or are there a few people, Subra, who would you say may not need life insurance?
Life insurance is needed by almost everybody, assuming there is somebody dependent on you. So if you're married and your wife is not earning as much as you do, so your lifestyle becomes very different. So suppose you are earning 50 lakhs per annum and your wife is earning 10 lakhs per annum, or vice versa, then the person getting a bigger salary needs to be insured, because then it is the lifestyle of the 50 lakh rupee salary that happens. So that person needs to be insured. If you have a loan, you've taken a housing loan, car loan, any other type of loan, you need that to be covered. You need your children's education to be covered in the future whenever it happens. But if you're, say, 55 years of age, 52 years of age, your children are more or less settled down, you started earning, your wife is also a professional, she's also earning well, you put together a corpus required for your retirement, everything has happened. That's the stage when you cease to need insurance. So normally a 25-year-old, 26-year-old would need insurance, assuming that he or she is going to get married and have children, etc. But child of a rich parent who is not planning to get married, not to have children, who already has a house, not going to borrow, maybe those are the exceptions, but those are quite abnormal. So 95% of people need life insurance.
This is because I want to talk about the definition of life insurance in its purest form, which is it is something that protects you from the risk of loss of future income, or rather protects your dependents from the risk of loss of future income. Is it very important to define what is insurance and what is not insurance? And how do you understand what is offered when you say, I want to buy a life insurance policy?
This is like when you go to a hotel and you ask for something, he said, do you want this top on? Or do you want me to add this on top? And things like that. Those frills. Okay, if you remove all the frills, there is the pure insurance called term insurance. This is pure insurance. This is like medical insurance or accident insurance. If you fall ill and you have a hospital bill, somebody will pay for it. So in term insurance, if you die, your family will get paid for it. Your family means somebody dependent on you. It could be your parents, it could be your children, it could be your spouse, it could be a brother whose education you're funding, it could be a school teacher whom you're paying 500 rupees per month or 5,000 rupees per month for her upkeep. Anybody, you could have anybody like that saying such and such a person should get this money. So that is what term insurance does. It does a financial compensation of which you would have done if you were alive. So if I'm alive and paying for my wife and children's education, my wife's upkeep, etc., then to that extent that they will miss me financially, it can be compensated by me paying a premium and transferring the risk from my wife and children to the life insurance company. So that when I die, they will get a lump sum payment with which they should be able to fund themselves. Normally, people say perennially, I'm saying next 10 years. By the time your family are just not having your income around, they would find something to do. So next 10, 15 years expenses should be provided. All the loans should be repaid, and your wife should be able to continue to live exactly the way she was living without having to work, because you don't want the children to lose one parent to death and one parent to a full-time job. So your wife should be able to, assuming she's a housewife, for her to be able to sit at home, be with the children, and not worry about paying the bills.
Scenario that you've outlined. So then, can I follow that up by saying that you might need life insurance at one stage of your life, but assuming that all of your plans go the way that you want them to go and you earn a certain amount of corpus, you can then stop at some stage requiring a life insurance product. Is that fair?
Yeah, Alex, that's perfectly right. And that you should have an insurance which has no penalty for stopping, right? So, like medical insurance or car insurance. If you sell off your car, you don't pay insurance the next year. So, if you buy a car, nobody comes and tells you, here, pay the premium for the next 20 years. Because you may use the car for 5 years, 7 years, 9 years. Suppose you decide that you're going to use it for 9 years, but you actually sell it off in the seventh year. In the seventh year, you stop. So exactly like that, you will take term insurance. Right now, you think you require so much. But let's say your wife works in some company which gives her 2 crores worth of ESOP. Suddenly your net worth has gone up and you realize that you now don't need that insurance. You should be able to drop. That can happen only if you take a pure term insurance.
Understand what other types of insurance there are then. So you divide it therefore into, and we were talking about this before we started on this program, term insurance and not term insurance. But when you say not term insurance, essentially you're talking about endowment, right? So what are the different types of insurance products so that when somebody goes out and is speaking to somebody, they know what is being told to them?
Yeah, Alex, that's very nicely put. There are only two products from any insurance company apart from pension. One is called a term insurance and one is called an endowment insurance. What you need is pure term insurance. But the insurance companies like to have a plethora of products where there is more term and less endowment, or less term and more endowment, right? Some combinations will be available. So a money back policy is just five endowment plans stuck together, right? That's what it is. So your plan should be a pure term insurance so that you keep paying for it as long as you need it. So you don't take a limited term payment. Like if you want insurance for 20 years, you want to pay for all the 20 years. You don't want a pension, you don't want a term insurance which you pay only for 5 years and then it continues for 20 years. Because you'll never be able to stop it. And you will have insurance for a period which you do not actually need. So it has to be a pure term insurance payable regularly. So you don't want a term insurance with return of premium. Now that is a bad version of the regular product. It's like if I tell you potatoes are good for health, I mean boiled potato eaten maybe without even salt. But that does not mean you should eat fries. It does not mean you should have potato chips dipped in ketchup, right? You don't want those versions of term insurance. So seek a pure term insurance with regular payment, ideally quarterly payment of premium, if not quarterly, half yearly, because that will help you throughout the policy exactly when you don't need. If you don't need it in June and you're paid premium up to September, from October you don't need it. Why should you buy such a product? Very simple, because term insurance premiums can keep going down. With competition coming, premiums could go down. So if the premium goes down, you should be able to switch from company A to company B. Therefore, a term insurance with a quarterly payment of premium is the best product you can think of.
Okay. Uh, would you then compare it, and I know that it's not a like to like comparison, and you have alluded to this already, to a motor insurance policy? I think the issue that a lot of Indians have faced is this mentality that you are spending for something, you're not using it, and therefore you want your money back. This is, and I've had conversations, Subra, with people saying, look, I'm filling this premium, but the eventuality did not take place, so I want my money back. Whereas that isn't the approach when you have to buy motor insurance, because it's compulsory to do, and whether you want to or not, you have to buy insurance.
Yes, and what you're saying is right, but the problem is you're not paying exactly the same amount. So suppose for an X amount of insurance, you're paying 5,000 rupees per annum as a pure term insurance. The premium that you pay for getting the money back would be something like 8,000 rupees. The worst thing is after 5, 6 years, you say you have taken a 25-year policy, and after 5 years you realize that you do not need that insurance. Then you don't feel like surrendering, because you know that if you pay for the whole term, then you will get back the money. So now you're tempted. You keep on buying a product which you do not need just because you want to get the money back. So you're trapped in this. So Alex, it's very important to understand that there are two products here. One is an insurance product, pure insurance product, and other one is like a bank recurring deposit or something like that, right? So don't combine the two, because after 5 years, if you don't need insurance, why would you continue it? So you will throw it up, but you still need your wealth product, right? So for your wealth product, you continue your mutual fund and you take your term insurance. But after some years, you will find that you can't pay into the mutual fund. That's fine, but your risk does not stop. When you combine the two, then you are caught in the horns of a dilemma saying, oh my God, I want money and I can't afford to pay this insurance, but I need the life cover. So what do I do? Therefore, you keep the product separate, not only because it's expensive or not expensive, or you can't change the fund manager. Those are other problems. But this is the reason why you keep the two separate.
I've taken the point. Now, when it comes to actually taking a life insurance cover, if you're out in the market, you want to look for a term insurance policy. What is the amount that you should go for? And of course, the earlier you take it, Subra, the better it is, because of various reasons, because the risk, of course, to the insurance company is less. So therefore, you get an attractive premium. But how do you choose the amount that you should get for cover?
So, Alex, the best thing to say in a program like this is to say 10 times your annual income, because that is the formula which is easy to remember. So, somebody earning 10 lakhs a year, it's a 1 crore of term insurance. That's easy. The more difficult one is to say, see how many people are dependent on you. Let's say your parents were dependent on you, your wife who is currently given up a job to look after the kids, so she is currently dependent. Your and maybe your in-laws are partially dependent on you because your wife gives them some money, and you have a 1 crore housing loan, and you think your child will need about 1 crore for education. Then you need 1 crore to repay the housing loan. You need 1 crore for your child's education. You need to put away some money for your wife's retirement. She may look for a job, but you don't want her to be pressurized into looking for a job on day one of losing you. So therefore, you say, okay, you sit and enumerate all this. You say, okay, my parents might need 20 lakhs, my in-laws might need 20 lakhs, my wife would need 2 crores for her retirement, I would need 1 crore for home loan repayment and 1 crore for my kids. So you add up all that and say, okay, I need so much of insurance. How much can you get? You can get about 20 times your annual income is what you can get as insurance, maybe little less. So that's the amount of insurance you can get. Please also understand it's not, you can't, it's not open-ended, right? So a person with a 2 crore income cannot get a 400 crore term insurance. You'll get only 40 crores, right? 10 times, 20 times maximum is what you will get. So that is how much you should pay, but you should not take too much of insurance, and you should be able to drop the insurance in parts. You should be able to go and say, here, I have a 2 crore insurance, I need only one. So please make this a 1 crore policy. Some policies allow you to do that. So that's the best way to take. Because once the loan is over or something like that, you can drop that portion. You don't need it. So that is one way you can take.
Am I understanding this right in that you take term insurance if you don't have the means to take care of your financial dependence for the rest of what would normally have been your life? When you reach the stage where you're reasonably confident, you essentially retire the term insurance policies that you've taken because you have enough money, right?
Yes. I know one company which allows you to reduce the policy itself. So you have a 2 crore policy on which, let's say, you were paying 2 lakh as premium. Now you want to make it a 1 crore policy, you will be able to make the premium 1 lakh and continue. But if you're not very confident, then you take, suppose your daughter is 12 years of age and you think you will require money in 10 years, or for 10 years, you need a higher protection. So you take one term insurance for 10 years. You have a home loan for 12 years. So you take one policy for 12 years and you take one general one, which you think your spouse will need till your age of 60. So you take one till the age of 60. But there's absolutely no sense to take insurance beyond your age of 60. Though such products are available, it makes no sense because what you're trying to cover, Alex, as you said, it is trying to cover the money that you were earning when you were around. So your bank will continue to pay interest on your fixed deposit, whether you're there or whether your wife is the nominee. Doesn't really matter, right? So your earned income has to be covered. Your unearned income need not be. So for a film star, the money that he's earning from his movies have to be covered. For a cricketer, what he's earning from everything has to be covered. But his own investment income need not be covered. So it's your earned income that you.
We've covered all of the bases, and I'm hoping that all my viewers who've heard this will spread the word, because that's essentially how good news and also good personal finance practice will spread. Thank you so much, Subra, for taking the time.
Thank you, Alex.